Welcome to StokTok's deep dive into Canadian Imperial Bank of Commerce. CIBC is one of Canada's largest financial institutions, providing retail banking, commercial banking, wealth management, and capital markets services to clients across North America and internationally. As of May 1st, the stock is trading at $112.15. Over the past 52 weeks, the stock has ranged from a low of $63.40 to a high of $111.93, so we're trading near the upper end of that range. The 50-day moving average sits at $100.91, while the 200-day moving average is at $87.74. The Relative Strength Index, a momentum indicator, is reading 71.2, which signals overbought conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Canadian Imperial Bank of Commerce generates revenue primarily through net interest income, the spread between what it earns on loans and what it pays on deposits, as well as through fees from wealth management, investment banking, and capital markets trading. The bank's competitive moat rests on its large deposit base, regulatory barriers to entry in banking, established relationships with institutional and retail clients, and geographic diversification across Canada and the United States. Our StokTok score for this name is 31 out of 100, which signals caution. Breaking that down across 5 dimensions: valuation scores 4 out of 20, financial health scores 9 out of 20, profitability scores 6 out of 20, growth scores 10 out of 20, and smart money scores 2 out of 20. That profile is a yellow flag across the board. Now, valuation. The question every investor has to answer: are you paying the right price? Canadian Imperial Bank of Commerce is trading at a price-to-earnings multiple of 16.18 times trailing earnings. The forward price-to-earnings ratio is 14.91 times, suggesting some modest compression as the market prices in future earnings. The PEG ratio, which divides the PE multiple by the long-term earnings growth rate, sits at 2.14. A PEG above 1.5 typically signals that growth does not justify the valuation premium, so this warrants caution in our view. The price-to-sales ratio is 4.76 times, which is elevated for a mature financial institution. The enterprise value to EBITDA multiple reads 0.00, largely because the company's capital structure and asset-heavy nature of banking make traditional EBITDA multiples less meaningful for this sector. Our proprietary discounted cash flow model suggests the stock is trading at a negative 34.78% margin of safety to intrinsic value. In plain English, that means the stock appears to be trading at roughly a 35% premium to what our model calculates as fair value. That is a material overvaluation signal. Wall Street analysts have a consensus mean price target of $104, with a high target of $115 and a low target of $86. 3 analysts are currently covering the name. Most recently, Canadian Imperial Bank of Commerce reported Q2 2025 earnings. The bank beat analyst expectations on earnings per share, delivering $2.05 actual versus $1.90 estimate. However, revenue came in at $8.32 billion against an expectation of $27.91 billion, a significant miss on the top line. Net income was $3.09 billion. Revenue growth on a year-over-year basis was 10.2%. After the earnings announcement, the stock surged 2% in after-hours trading, suggesting investors focused on the earnings per share beat despite the revenue shortfall. The market reaction indicates some relief on profitability, though the revenue miss deserves attention. Canadian Imperial Bank of Commerce trades at a multiple that exceeds the banking sector average in our view, and given the earnings growth profile we will discuss in the growth section, the valuation appears stretched. Market sentiment around Canadian Imperial Bank of Commerce leans bullish, with a sentiment score of positive 0.35 on a scale from -1 to +1. That bullish lean is supported by management's focus on strategic expansion into fast-growing financial segments and demonstrated innovation in business diversification, though broader competitive pressures in banking remain a consideration. Our assessment: valuation is not attractive at current levels. Moving to financial strength, how solid is the foundation? We start with the Piotroski F-score, which is a 9-point checklist that evaluates a company's financial health across profitability, leverage, liquidity, and operating efficiency. Canadian Imperial Bank of Commerce scores 8.0 out of 9, which is excellent and signals a fundamentally healthy business from an accounting quality perspective. The company passes nearly all profitability and leverage quality checks. However, the Altman Z score, which is a bankruptcy risk model that weights profitability, solvency, and efficiency metrics, reads 0.00 for this name. An Altman Z score below 1.81 signals distress, and 0 represents extreme caution. This stark contrast between the Piotroski score and the Altman Z score is notable. It suggests that while the bank's accounting is sound, its leverage and capital structure present material financial risk in the eyes of the bankruptcy model. The cash-to-debt ratio is 0.22, meaning the bank has only 22 cents of cash for every dollar of debt. For a financial institution with a leverage-heavy business model, this is structurally normal but reflects the inherent leverage in banking. The debt-to-equity ratio is 3.37, indicating that for every dollar of shareholder equity, the bank carries $3.37 of debt. Again, this is typical for banks, but it amplifies both returns and risks. The interest coverage ratio is not available, which means we cannot directly measure the bank's ability to service its debt from operating earnings, a gap we must note. The current ratio is 0.00, which is misleading. Banking institutions do not calculate current ratio the way manufacturers do, since their liquid assets are cash and securities rather than inventory. On balance, the health picture is mixed: strong accounting quality, but a capital structure that carries material leverage and elevated distress signals. This is a foundation that requires careful monitoring. Next up, profitability. Is this business actually making money efficiently? We measure this through return on invested capital, or return on invested capital, which shows how much profit the company generates for every dollar of capital deployed. Canadian Imperial Bank of Commerce's return on invested capital reads 0.00, which reflects the complexities of analyzing banking profitability through traditional manufacturing-focused metrics. The metric is not meaningful for banks due to their asset and liability structure. Instead, we focus on return on equity, which measures profit as a percentage of shareholder capital. That reads 14.85%. ROE of 14 to 15% is respectable for a large, mature bank, indicating reasonable profitability on shareholder capital. Return on assets, or ROA, is 0.85%, a modest but appropriate return given the asset-heavy nature of banking. Gross margin is 0.00%, and operating margin is 0.00%. Both figures are not applicable to banking, since banks do not have a traditional cost of goods sold structure. The meaningful profitability metric for banks is net profit margin, which is 31.11%. This tells us that of every dollar in revenue, Canadian Imperial Bank of Commerce keeps 31.11 cents as net profit. That is a strong net margin and reflects pricing power and cost discipline. Free cash flow margin, however, is negative 2.45%, which signals that the company is not converting earnings into actual cash at the same rate. In the Q2 2025 results, the company's net income of $3.09 billion and revenue of $8.32 billion produced a net margin consistent with this annual figure. The revenue miss, combined with the free cash flow headwind, suggests the company faces conversion challenges, strong accounting profit that translates to weaker cash generation. Onto growth. Is this business expanding, and at what rate? Over the trailing 3-year period, Canadian Imperial Bank of Commerce has grown revenue at an annual rate of 10.10%. Over the trailing 5-year period, revenue growth has been 7.70% annually. That slowing trend, from 7.7% to 10.1%, actually shows acceleration over the most recent 3 years, which is encouraging. However, these growth rates are modest for a financial services company and significantly below what equity investors typically expect from a growth investment. The most recent quarter, Q2 2025, showed year-over-year revenue growth of 10.20%, which aligns with the 3-year trend and suggests the acceleration is holding. Book value growth over the trailing 3 years has been 7.70%, which lags revenue growth slightly and implies some dilution or capital distributions to shareholders. The dividend yield is 2.67%, providing income but not aggressive enough to compensate for slow revenue expansion. Going forward, the market consensus is for earnings per share of $2.42 in the next earnings cycle, with a range from $2.30 on the low end to $2.62 on the high end. That represents modest earnings growth from current run rates. The growth profile is defensible but uninspiring. A business expanding in line with the broader economy but not capturing outsized gains from emerging opportunities, despite management's stated focus on diversification into fast-growing segments. The growth score of 10 out of 20 reflects this tepid trajectory. Now let's talk smart money. What institutional capital is actually doing with this name? 6 top-tier investors, whom we track through publicly available 13F filings and Guru portfolios, currently hold shares of Canadian Imperial Bank of Commerce. However, the depth of conviction is shallow. Mayors and Power Funds, a respected long-term value manager, holds Canadian Imperial Bank of Commerce at 0.01% of portfolio, and minimal allocation that signals neither conviction nor abandonment. Insider ownership is 0.00%, which is striking. Management and company insiders own essentially none of their own stock. This is a red flag in our view. When executives and board members do not have material personal capital at stake, their incentive alignment with shareholders weakens. Over the past 3 months, there have been 0 insider purchases and 0 insider sales, meaning management is neither buying nor selling. That inactivity, combined with 0 ownership, suggests no urgency from those closest to the business. On the institutional front, 2.90% of all 13F filers are net buyers of Canadian Imperial Bank of Commerce, a figure well below the 50% threshold that signals net institutional bullishness. The phrasing here matters. 50% or above means institutions are rotating money in. Below 50% means institutions are, in aggregate, either indifferent or slowly rotating out. At 2.90% net buyers, institutional money is cautious to skeptical. The smart money signal is weak, conviction is low, insider support is 0, and institutional accumulation is negligible. This stands in sharp contrast to the bullish valuation sentiment we discussed earlier and is a meaningful warning sign that sophisticated investors are not backing the stock despite the narrative around strategic expansion. And finally, the verdict. Let's bring it all together. On valuation, Canadian Imperial Bank of Commerce is trading at a premium to intrinsic value with a price-to-earnings multiple that exceeds sector peers and a DCF analysis that suggests downside to fair value. Financial strength reveals a paradox. Strong accounting quality measured by the Piotroski F-score, but elevated distress signals from the Altman Z model and a leverage profile that, while normal for banking, concentrates risk. Profitability is solid on net income margins, but undermined by negative free cash flow conversion, meaning the bank is not turning accounting profits into cash at the same rate. Growth is in the mid-single-digit range, respectable but uninspiring, and insufficient to justify the valuation premium. Smart money paints the weakest signal: minimal insider ownership, 0 insider activity, and near 0 institutional accumulation, despite positive sentiment headlines. The combination of those 5 dimensions produces a composite thesis that warrants caution. The Q2 earnings beat on a per-share basis was offset by a material revenue miss, and management has not provided forward guidance that would justify the current valuation. Our interpretation of the publicly available data suggests the risk-reward is skewed to the downside at current prices. The setup is more suitable for existing shareholders to hold and collect the 2.67% dividend, while monitoring for a reset of valuation multiples, or for new capital to wait for a more attractive entry point. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Canadian Imperial Bank of Commerce. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.